In this video, I'm going to walk you through what is a put option. Should you be buying put options, selling put options, what I personally do, and how I profit and make thousands of dollars every single month using this greatest option strategy. So if you like the sound of that, all I ask for is that you smash that like button and don't forget to subscribe. Now, in my last video, I talked about how much money I made trading options, and one of my top 3 strategies was the classic put option. So firstly, let's go into what a put option is. And once you Google it, Gemini AI will come up and say a put option is a financial contract that gives the holder, i.e. the buyer of the put option, the right but not the obligation to sell an asset. In this case, it's going to be a stock at a specific price by a certain date known as the expiration date. Now, if you are brand new, that might sound like a bit of a handful or a bit of a mouthful to get your head round. So let's go into an example of this and why would someone buy a put option. So I've got Amazon stock here as an example. By no means I'm telling you to buy a put option or sell a put option on Amazon. It's just for illustration purposes and what you can do and why someone would buy a put option. Now, people buy put options because they may think that the market is going to go down. So from a trading mindset, you would buy a put option if Amazon's sitting at 192.72. If you buy a put option and Amazon does go down, that option would increase in value and therefore you can profit on that. So I'm not going to talk about trading put option from a buying perspective. I'm going to talk to you in a mindset of a long-term investor. So let's say, for example, I own 100 shares of Amazon at a cost basis of 100, and let's just say I timed it perfectly at this low over here. So I bought 100 shares and I've been riding the wave all the way up to this latest high of around $242. So over 100% return. And as we've seen in the market so far over the last few weeks or last month or so, we have seen a massive decline, not just in Amazon, but in every single stock you can probably imagine. And the price currently sits at 192.72. Now, I'm still way above my cost basis here of $100. So, 92% up on my money, which is fantastic. But I would like to purchase some protection or insurance, for another word, by buying a put option. And if we go back to the definition, it allows me, the holder, so if I buy a put option, the right but not the obligation to sell an asset at a specific price by a specific certain date. So what I can say is, what? I'm really worried with Trump and the tariffs and all these kind of things, or the market or inflation rising higher than expected. I think Amazon could go all the way back down to 100 in the coming months. Let's say that's my assumption. So what I can do is I can go out into the options market and go buy a put option to protect me in case the market does fall. Now, in this example, I've said here, and we'll go into an option chain to see how much this would cost me to do, is I have purchased, in this fictitious example, the May 16th 160 put. So if we go back to the definition, what this is saying is by May 16th, between, let's say I purchased it today, between today and May 16th, at any point in time, even if we're above the market, which it would be quite stupid for you to exercise your option while it's above 160. But between now and May 16th, I can sell my 100 shares of Amazon that I bought at $100 for $160. So even if Amazon goes under 160, I got peace of mind knowing that I could sell my 100 shares at 160 because someone has sold me the right to do so. Even if Amazon goes all the way down to $80 before March 16th, I can still exercise that option by May 16th to say, you know what, the price is 80. However, I'm going to sell you my 100 shares at 160 because we shook hands at that point in time. And that's basically what a put option gives you from an investor point of view. It gives you insurance. So it's the same example of when you buy car insurance. So if I go and I am paying an insurance company premium of, let's call it $1,000 a year to insure my car, that if, God forbid, I get into an accident and my car is absolutely totaled and the value of my car is $20,000, I know I can get the equivalent car or $20,000 in cash value for me to go get a car or equivalent car, but it cost me $1,000. So in this example, it's not free for me to go buy a put option at 160. Someone has to be willing to place that trade. Like an insurance company, they are taking a risk or a gamble, whatever you want to call it, or in insurance terms, a calculated risk that in the next 12 months you won't teetotal your car, and therefore I'll keep 100% of the premiums of that $1,000. So on the other side of the fence, someone like me, who is an option seller, I might say, actually, hold on a second. Let's say it's $300. I'm making this up. We'll go check the options chain in a second. That, let's say it was $300, the market value to buy a put option at 160 for the May 16th expiration. I would then come in as a seller and say to the person that owns this 100 shares of stock, saying, I am willing to buy your 100 shares at 160 on or before May 16th, and it's going to cost you $300 for that right to do so. And again, now if we go back to the definition again, it gives the holder, so the buyer of the option, the right but not the obligation to sell the asset at a specific price by a certain date. Now, I don't have to, as in the buyer does not have to exercise that option. They just have the right, a piece of paper or electronic piece of paper that says that you can sell your stock at 160 between now and May 16th, and it costs you X amount of dollars. In the example I gave, $300. So it's not free. So in the car insurance example, is even though in car insurance you've got to do that by law, is I'm paying $1,000 to protect the value of my car at 20 grand or whatever it is. So it's the same thing, is I'm protecting my cost basis of $100 at the 160 strike. Now, Amazon could go all the way back up again, and same thing is my car might not get teetotaled. I still lose that premium that I sold to someone like that $1,000 or $300. So let's go have a look at what this looks like on an options train. So I've got Tasty Trade up, I've got Amazon up, I've got the May 16th expiration. And what we want to do, we've got the 160 strike, and I'm going to buy that option. And you can see here that it is $1.67 per share, and with options contracts, per contract is 100 shares, so you need a minimum of 100 shares to buy or sell options. It's going to cost me, if I wanted to do this, $167 to go and protect myself at the 160 strike. Similar to the car insurance one, is I am paying $1,000 in that example to protect my car if in the case it does get teetotaled or something happens to that car. And that is basically the same thing of what a put option is from a buyer perspective. And so if I delete that leg, now if I came in as an option seller, I would go on this side and sell that put option and say, look, I'm willing to buy 100 shares at 160, and I will take the risk, because the maximum risk, as you can see here, the max loss is 15,000, which is if Amazon goes to zero between now and May 16th, which is not going to happen. So again, their platforms have to state what your max loss is, but Amazon ain't going bankrupt anytime soon, especially inside the next month or so. It could go lower than 160, but it's definitely not going to go bankrupt. Now, The thing you've got to realize here is similar to car insurance business model, is a lot of the times, I don't know the exact percentage in that world, but they make most of the time they don't need to pay out because cars don't get into accidents and all this stuff. And when a car does get totaled and they do need to pay out, the premiums from all the cars that they've insured that didn't pays for the ones that they do need to pay out and then some more. So therefore that's how they make their money, because they do lots of $1,000 premium situations, and let's say it's $100,000 worth of premium that they've collected, and they had to pay out $60,000 in terms of, wipeouts of the cars. Therefore, they make $40,000 profit. So this is a high probability strategy depending on where you place your strike price in this example. So here, if we look at this example here, the 160, the probability of profit is 93%. So what it's saying is 93% of the time, this option, i.e. the 160, will expire worthless. What does that mean? That means that Amazon, by the date of expiration, will not be at below $160. Now, that's not to say that it can't happen. Again, we've seen this is a very aggressive move. If we tail this down, you're probably thereabouts in the space of a few weeks. So it is possible for that to happen. But again, as an option seller, which is what I am and what an insurance company is, they are playing the probabilities. And over the long run, as even with the casino, the probabilities play out as long as you keep playing the game. Now, if this as a one-off isolation trade, if Amazon went to 149, for example, I would then have to buy 100 shares at 160, and then you can do other funky stuff with that, but that's not the purpose of this video. If I did this trade 1,000 times, right, 993 times I would be right, 7 times I'll be wrong, but the premium I've collected across the 1,000 times should pay for the 7 times I'm wrong, and therefore I still would have profit left over. So again, this is all about variance, the number of occurrences. So when people trade options or they sell options and they sell an option and the price completely drops and it goes past their puts drive, they're like, this doesn't work. Whereas you got to keep doing it, right? You got to keep finding the right trades, finding the right stocks, and there are certain ways to do that using implied volatility and all these good things to put the odds even more inside your favor. But in this example here, what you can see, there's a 93% of profit. There's a 92% chance that you will at least reach 50% of this number. So what this means is as an option seller, the max I can make in this trade is $164. Similar to car insurance, the max the insurance company can make off me as one individual is $1,000 inside that example. Now, unlike car insurance, you can't get out of the trade or cancel your car insurance and keep the difference 6 months into your term. Generally, it's fixed for a 12-month term. However, even though from a buyer perspective it is fixed until May 16th, you can buy back the option effectively and pass it on to somebody else. So from a buyer perspective, you have no idea who you've sold this option to, and it could change 20 times, 1,000 times throughout the course of this. But as long as you know you have got a 160 protection on there. So let's say Amazon goes up, sideways or down, but nowhere near 160. Over time, this will decay because this eventually has to go to zero, right? And let's say it gets to $1, so therefore you've made 64 cents or $64. You could close out this trade and you could pocket as an option seller $64 of the 164 that you can collect. So again, this is all part of taking profits early, managing at 21 days, all the things that if you guys have been on my channel know that what I talk about. But again, this is just an overview of what it means to sell a put option or buy a put option. I'm not going to go into the theta and all these kind of different things. The only thing I will talk about is the delta. So the delta there's many definitions of delta, but it's effectively the probability of the option being in the money at the day of expiration, i.e. below 160. and it's sitting at 10.55, which if you inverse that from 100 minus 10.55, we're around the 90% mark, which is very similar to the probability of profit. So again, we're saying even if you just look at delta, because probability of profit is a proprietary thing for tastytrade, most platforms will have a probability of profit. But a quick and dirty view is when you look at the delta, in this case, rounding up the delta to 11, you are basically saying that you have a 91% chance of, or an 89% chance, 80 to 90% chance of this option expiring worthless, i.e. it's going to expire above 160 at the date of expiration. And again, this is what I look for. I look for these high probability trades where, I always aim to make above $1 on the trade. And again, depends on what the stock is here. And because I'm on a margin account, again, this is going a bit too much into the detail in terms of like return on capital and all these kind of good things, because not all trades are equal. It will depend on the stock price, what's the probability of profit, how much margin or buying power do I need to use, etc., etc., etc. So there's a number of things. I'm not saying this is the right trade to do. It's just an illustration example of this. And if you are interested in those things, again, you can subscribe. I can do some more content on that. But this is just a very high level view on a put option from a buyer perspective of protecting themselves in case of the market dropping down. But from a seller perspective, picking the right strike. So again, there'll be people that want to buy options, and you can see this on the options chain at different strike price. And you can see the closer you are to the actual current price, the more risk it is for the option seller, but the more expensive it is for the option buyer to go protect themselves, because it's more likely, and you can see here now it's 77% probability that Amazon will be below 180 by the date of expiration. So again, as an option buyer, you've got to see, because this money you've lost, regardless if, you actually will make money, obviously, or protect yourself if Amazon does go down. But again, you've got to hedge your bet, and that's why knowing your cost basis and all these things and what you're happy to kind of pay in terms of that premium to have that peace of mind and that protection across your cost basis for Amazon in this example. And as an option seller is how much risk you want to do and all these kind of good things. So one thing that I like to do, which I talk about on this channel, is if I want to buy Amazon, or if I think Amazon is undervalued at 160 as an example, I'm going to get paid to buy 100 shares of Amazon stock at a price that I actually want to buy Amazon. So instead of waiting for Amazon to get to 160, I am selling put options around the 160 mark, collecting premium. So worst case, if Amazon does skyrocket even higher to 200 plus, I'm still making some money on this trade. An example I'm doing is Nike at the moment. So Nike is valued at, currently it's valued at 63, and if you guys know, I've got a put option expiring in April at the $70 strike. So at the moment I am in the money on this put option. So if I did nothing and it stayed below 70, I would acquire 100 shares. Now I've done a lot of intrinsic value analysis, and I'm quite happy with Amazon at 70. I think I did this when Amazon was around the 73, 74 mark. So it really has taken a big dip. And again, you'll see this in the chart if I just do it on here. Amazon has taken a massive dip over the last few months, as most stocks have. And if you turn around as the option seller and saying, you know what, I really don't want Amazon at 70, but I'm stuck here, it's at 63, what am I going to do? Again, make sure you subscribe, comment down below if you want to know what I do. And again, if you are interested, and I can show you what I would do in this example, and we can use my live example of my night trade if that's something you're interested in. So I really hope you've enjoyed this in-depth video around put options. This is one of my favorite strategies in terms of selling options to generate premium. And I should see you guys in the next video.